Just as we get set this weekend to mark the 10-year anniversary of the bull market, this conversation is wondering whether it's going to end, I don't know, maybe momentarily. The markets are battling some key technical levels this week. Don't worry, the chart master is here to tell us what it all means. Why don't you go over to the plasma and show us?
Sure. So on the way to the plasma, let's just note that, of course, the bull market did end. The NASDAQ composite dropped 24%. The Russell 2000 dropped 27%, and the S&P dropped more than 20. We've had a bear market. Now the question is whether we're recovering and we're going to make new highs, or that this impetuous bounce, impulsive, steep, uncorrected, is just that, a bounce. No lines or drawings by me. Let's put in a few and see what we can figure out. So here's a chart of the S&P, and what we know is, again, while the 2,800 level was cited, that's not the level that has mattered for the market. We've had three well-defined intermediate tops, 2817, 2815, 2815. And the market hit that level exactly last week after news on the trade front and has pivoted straight down. We know the transports have just had a record sequence of losses. And so is it just a bounce? A couple ways to draw the lines. On the way up, we have had four distinct pullbacks, and you can see them here. So this was a 3%er, this was a 2.3, this was a 2.1, and this is 3.4. The bull would say that that's just a normal give back, and that we're on our way after this little give back to doing big things like that. My hunch is otherwise. I think ultimately we still have a lot of risk to the downside, and at a minimum that we're likely to find a reference point, as we found before, here, just as we had reference points at the high at 2,800, and that a normal check back is not going to be 3% after advancing 20, but it's more like 7, 8, 9, which would get us down to the bottom of this channel. And I think that ultimately is what has to be considered before one could even think about putting money to work, because we've dipped. We haven't dipped at all. We've gone down 3%, and that is nothing.
So, Carter, I had thought that we were going to recheck those lows that we saw, the 2350 range. I agree with you. I think it's more like 5 or 7% down from here. Is there any shot in your mind? I know there's always a shot. So how credible is another shot down to 2350?
I think it's the best bet you can make, meaning this is a minimum. The real question is, do we – now, it's important, right? People use the word retest. It would be a test. If you have a low and you go back there, you're testing it. If you go back there a second time, you're retesting it. So do we test the lows? I think we do.
The best bet we can make is that we're going back to retest the lows? That's what I just heard you say?
I mean, here's the thing.
A little unsettling on this Friday evening.
Well, let's just talk about it. Remember, the market didn't peak in September, October. That was a fake new high. Industrials peaked in January of 2018.
But Carter,
materials peaked in 18. Energy peaked in January of 18. Staples peaked. It was only, quote, the S&P because FANG that we had that head fake. It turned out to be one of the great bull traps of all time. Global equities from the MSA, all world country, all of them, all peaked over a year ago, and they've never gotten better.
Hey, Carter, we talk fundamentals, so let's just talk charts because that's what you're there to do. We've seen this V before.
I can do both if you'd like.
Sorry, but we've seen this V before, right? I mean,
he look like a one-trick pony to you?
I'm sorry? No.
Does he look like a one-trick pony
Carter,
to you?
if I was going to draft a team right now, he'd be the best athlete available, right? Okay, so to be clear, if I misspoke. But haven't we seen this V before, Carter?
You're talking about a V bottom like that?
Yeah, so, well, I mean, look, that was historic, but we've seen Vs of 5%, of 7%. These haven't been Ws. They've been Vs. Had a conversation with a client about that today. I mean, I think that's a fair point.
Right. So, well, you're talking about this kind of thing versus how many real Vs are there in terms of drawdowns in the S&P of 15%, 20%? Do you not get a test?
We know that. We know this was historic. I'm not saying this is like anything we've seen, but I'm saying in the last 10 years, we've seen these moments where the market has been right here on a proportionate basis slower, but clearly a moment where we thought this was it.
Yeah, I mean, again, I would say just look at the message of utilities, the fact that rates are doing what they're doing, that financials are not working, and that worse than anything, it was too steep. If we'd spent some time healing after the Christmas low and working through it, the fact that it happened so quickly is not a positive, it's a negative. It speaks to, frankly, a panic. There was a panic in December, and there's an equal and opposite panic now as money aggressively tries to catch up. And yet, that money that drove us higher in January and February can become an accelerant on the way back down as it has to reverse if and as things get worse.
The point you're making, you're disputing the fact that you think this is simply a bear market bounce. You think this is a legitimate reversal?
Look, I think Carter made a great point, which was that we essentially took an extreme downtrend and put in an extreme uptrend and canceled them out because the Fed basically that's exactly what the Fed did. So I realize earnings aren't sexy. I realize the global economy is not in great shape. We've been in places where equities have actually performed in that environment.